Hi, I'm Jain at Active Allocator. As you're probably aware, we monitor market commentary around this time of the year. So I came across a rather interesting piece by a large firm, and let's just call them SS. So these guys expect global growth to slow in 2019. They are constructive on US equities, which they say is going to be driven by earnings momentum, a combination of tax cuts, immediate expensing of capital expenditures, and of course mandatory repatriation of overseas profits, and a general broad deregulation push. So all of this should incentivize capital expenditure. They also see modest inflation and wage growth, but no risk of recession. And the risks that they see come, of course, from geopolitics and policy. Nothing surprising about that. They say the economic cycle is mature, calling for defensive equities, high quality credit, and emerging markets. So in terms of regional markets, the position is that the US is expected to outperform all other markets. And as I said earlier, this is going to be driven by higher capex, government, consumer spending. And now with the Democrats in charge of the House, these guys are going to push for infrastructure spending. And they say that risks may come from, and so does everyone, policy mistakes, things like escalating tariff, etc. On Europe, they say politics continue to dampen European sentiment. And the biggest driver is the March deadline for Brexit. On emerging markets, they say that valuations relative to all other markets are at an all-time low, and consumer-related tech sectors have become much cheaper. And they see a similar case in EM bonds and currencies. China naturally is the elephant in the room, and the trade dispute, the US stance on strategic containment, which is to prevent China from increasing its competitive advantage in areas like AI, quantum computing, biotech. So we all know there is a fundamental shift in relations between the US and China, and tariffs and disputes with the US will bring volatility, especially now that since EM equity and debt indices are beginning to include Chinese securities, which I thought was interesting. I wasn't aware of that. On the subject of reducing risk in fixed income, so we know that advanced economy central banks are tightening and normalizing their balance sheets. US rates now have risen and the yield curve will continue to flatten. So they advocate a defensive positioning, and they recommend overweight in US equities to favor the US dollar, which has been pretty strong, short duration bonds, and higher quality credit, as well as selectively local currency EM debt. They also say that within Europe, there might be attractive trading opportunities at a micro level within countries and sectors, depending on how those countries are affected by ongoing trade disputes. So they suggest increasing dry powder, I beg your pardon, in the form of cash to be opportunistic. And on the macro picture, with trade wars the biggest risk, the US is expected to outperform other regions on the back of the fiscal stimulus that we've had. And of course, it's going to be geopolitics that drive uncertainty and downside risk. And the trend towards monetary tightening should continue further and further. Unilateral sovereign actions promise more surprises. Inflation is still contained with almost no wage growth, which will take years. I was surprised when they said that oil is to be around $80 and core inflation too isn't expected to rise. Another interesting theme they touched upon is the synchronous tightening cycle. So one may see a convergence of monetary tightening in 2019, except in Japan. So you'll have the Fed, the ECB, the Bank of England, Bank of Canada, Australia. All of these look likely to raise interest rates. And in Japan, of course, inflation remains much too far below target to tighten. So with the Fed continuing to normalize its balance sheet, global liquidity should continue to diminish, and trade policy may act as a deterrent to capex and to consumer spending. Moving on to the UK and Eurozone, they say that that area is going to struggle. Of course, Brexit uncertainty has certainly taken a toll on the UK economy, particularly in business investment. So in the UK, there's sluggish wage gains, slowing home price appreciation, hindered consumption, despite a tight labor market. So even Europe continues to be challenged, and a reason for that is structural reform, since the global financial crisis has been limited to a handful of countries, while Italy still faces enormous fiscal challenges. European parliamentary elections, and this is a theme that we see many banks talk about in May, could see significant gains by EU skeptic parties. The next thing that they talked about was emerging markets, which they say are on shakier ground. So there's greater downside risk for China from trade tensions, a strengthening US dollar, rising financing costs, less accommodative domestic policy, etc. So AM will slow if debt levels increase and a lack of structural reforms. Brazil, Russia, India, all of these struggled against headwinds in 2018, and they don't see signs of these dissipating in 2019. Russia's recovery is shallow. India's rupee hit record lows against the US dollar recently, so forcing a relook at this whole emerging markets outlook. According to them, the big emerging markets question for 2019 is whether a faster than expected slowdown in China or other idiosyncratic risks in smaller EM countries could lead to broader market contagion, and that's a question up for grabs. On geopolitical outlook, these risks have increased as the world order continues to undergo transformation. International organizations, treaties, laws have gradually begun to cede influence to the unilateral actions of major countries, including the United States, based on raw political power. And moving on to hotspots for 2019, they say that expect the US-China dispute to continue, as there's no obvious exit strategy for each country. Equally, Russian interventions in conflicts and external relations continue, and reciprocal sanctions are unlikely to ease. In the Middle East, the confrontation with Iran is likely to loom large, and we have proxy theaters that we've seen this year in Yemen and Syria. Venezuela too is likely to continue to be a factor in commodity markets. And when it comes to Korea, they expect that their turns to last until 2020, assuming that there is no inflammatory move by either side. So the EU is strained on three levels: Brexit, Italy, ensuring the credibility of the monetary union, and then there are issues around Poland, Hungary, Romania. So in summary, this firm, let's call them by the initials SS, they expect global growth to slow in 2019. They like US equities driven by economic strength and earnings momentum. They expect heightened volatility, greater negative skew, and they don't see inflation pick up, wage growth, or recession. They say it's best to be cautious and buy defensive equities, high quality credit, and participate in emerging markets selectively across equities and local currency bonds. So I'll keep you posted on some more breaking investment and portfolio strategy research, which I hope will be useful for you to inform your asset allocation views for 2019. Thank you so much for listening in. Bye-bye.